Hello and welcome to this week's episode of For the Love of Chiropractic, Resources for Your Success. I'm your host, Dr. Robert Freeman. On today's episode, we're going to be talking about an old paradigm. They say the only two things in life that are certain are death and taxes. So while we have to take care of both of those things, imagine if there was a way to pay your taxes just a little bit later, hold on to that money just a little bit longer, and then put it somewhere that's really safe, that's tax-free. And then pay the government a little bit later, and you earn interest on that money tax-free. That's what we're going to be talking about today with our expert, a CPA with 40 years of experience, my longtime friend, Mr. Robert Zigman. Welcome to Season 3 of For the Love of Chiropractic. Season 1 has 60 episodes of practice management tips to help you build the best practice possible. Season 2, 3 keys of my success, 50 interviews with the most successful chiropractors from around the world. Season 3, resources for your success. So let's listen up and learn how to build a great business. So I have on the phone with me my longtime friend, Mr. Robert Zigman. He's a CPA of over 40 years experience, as I said in the introduction, and he's going to help explain how you can delay paying federal taxes, and that creates more money in your pocket. Bob, are you there?
Yes, I am. How are you, Bob?
I'm doing well, thank you. It's so good to catch up with you. And as I said in the introduction, you and I have been friends for virtually all our entire lifetimes.
Yeah, a very long time, yes.
So, and I'm really glad. I know it's tax season, but I'm glad that you can take a few minutes to help me explain something that I have taken advantage of for literally my entire practice career, that frankly, I don't completely understand, and you have explained it so beautifully several times. Specifically what I'm talking about is virtually everybody who's in business has to pay quarterly taxes. Is that correct?
That is correct.
Okay.
Everybody, not even just business owners. Theoretically, everybody has to pay their taxes throughout the year. Okay,
so somehow my first accountant set up a system where I never paid quarterly taxes, but I ended up paying one large tax bill at the very end of the calendar year, and it all ran through payroll. So effectively what happened, and I don't understand why that works, but it did. And so what happened was I was paid a reasonable salary as a doctor. And then at the end of each month, when he would reconcile the books for the practice, a certain amount of money stays in the practice as, to keep the practice running. And the leftover money, the profit, would then be divided into two halves. One half would become my draw. The other half got put away in what we called a tax savings account. And then I will talk about where that money went at some point. But can you talk about that?
Yeah, well, what your accountant was doing was basically, as I started to say before, the estimated tax responsibility. Most people don't think about the fact that they have an estimated tax responsibility because most people are employees, they get paid, and they actually pay their taxes every week or every pay period, so they're meeting their obligation of paying estimated taxes. But when you become a business owner, you don't have a source of withholding unless you pay your taxes. So you have to ensure that they do get paid timely throughout the year. But the way you were able to, in actuality, pay a lump sum or a very high percentage at the end of the year is because, as you said, it went through payroll. And what happens with payroll, by definition, if anything comes through on a W-2, that is deemed by definition to have been paid evenly throughout the year. So if one doesn't earn any money, let's say, or until December 31st, and they earn $100,000 and there's a $25,000 tax bill, that is still considered, in that case, a quarter of that 25,000, 6,250 paid each and every quarter, even though it was actually paid at the end of the year. Because what happens is the company sends in, information, and it is reported by the company and then just divvied up amongst the employees, reported on the W-2. And as I said, it's the IRS does not look to see exactly when the company, your chiropractic practice in this case, submitted those payments. It's just deemed evenly throughout the year. So effectively, you're going back in time. You're sitting on December 31st, and you're actually submitting a tax payment of 25% of that is going in April, 25% of that is going in June, September, and the end of the year. So that's why when you end up doing your return, those payments are then reviewed and deemed to have been paid timely throughout the year, and you will have met your estimated payment responsibility. So that is why it works. The mechanics of how it works would be intimate knowledge of the accountant and their client, the chiropractic owner, as to what is going on in their return, and then properly setting aside money throughout the period, like you said, every month, every period, whatever, and setting aside the amount of money that is needed or estimated to be needed. And then instead of paying the government, you set up, like you said, a tax account, some interest-bearing account. And it's not, one probably won't make millions of dollars on that, but they would better for the money to be in your pocket than the IRS's pocket. At least that's my opinion. And I just did a quick example. If we knew your tax liability was $100,000, in lieu of paying roughly, $8,000 a month, if you put that aside on your own account and you earned 3 or 4%, you would end up with a few $1,000s of interest at the end of the year. So effectively, you kind of got your $100,000 tax bill down to $98,000 by doing it. That is why you do it. The old adage, cash is king. You're holding on to it as long as you possibly can.
Right. And now what I always did was I placed that money in a tax-free bond fund that was specific for the state that I was living in at the time, because then the interest was both federal and state tax-free.
Yeah, that's correct. So that couple of $1,000s, let's say in my example of that, would produce the cash flow of the few $1,000s and would not trigger any additional tax, because that would be tax-free in that case, federally and state tax-free.
So is there any reason that a person should not do what we just talked about?
As long as you're disciplined and you're you're guiding your year financially properly, there's really no reason not to do that. One needs to have a good handle on the ability to estimate your annual taxes, and that comes from the experience with the accountant and history with a particular client, of course, and also looking at the progression of the year, because not every year is the same. Everyone's practice doesn't produce the exact same numbers every year, as well as other income on the personal return of the owner, the doctor owner.
Right.
To know what's going on in their return.
Right. Well, when you talk about a practice, practices not only are they not identical year to year. There are ebbs and flows throughout the year. There are certain months that are busier for some doctors and some months that are slower for some doctors. So by doing that on a monthly basis, you can basically work to keep the ship balanced. Is that correct?
Yeah. However the cash flow works, yes, there'll be absolutely. You might, again, with planning with the accountant, when things are a little bit more, cash flow is a little bit stronger, maybe you would set aside a little bit more of that number that we know you have to reach. And when the cash flow is a little tighter, the reverse would be true. And that in a certain practice, possibly that might be very predictable. Certain times of the year, one does better than another based on the history of that practice. But even if one was caught off guard for a spike or a valley, we could tweak that payment analysis accordingly, so that at the end of the year, we get to where we believe we have to be.
I like it. Now, I know throughout the years of doing that, I was always cautioned to make absolutely sure that that final payment did get in before the end of the year. And what I was always told was, or that would be a bad thing. Can you explain why that's a bad thing?
What would be a bad thing? I'm sorry.
If that final payroll payment is not sent into the government before the end of the calendar year.
Yeah, well, you need to, there are, in addition to individual tax requirements, the company is reporting, in this case, the practice is reporting the payroll from the employees, even if it's only one employee. It could be the doctor and by him or herself, or it could be, with other employees as well. So you have a fiduciary responsibility as the owner of the business to properly withhold and then remit those payments to the government, because exactly what we're talking about doing is what the government really doesn't want you to do. You can't withhold money from your employees, hold it all year, and then send it in at the end. You're not allowed to do that.
Right, that makes sense.
There are payment requirements when things are due. And in the case of speaking of the doctor, we're actually not declaring the payroll till the end of the year, so we're not really withholding the doctor's money yet. We're setting aside money from the practice. Then we declare it payroll sometime later, and then it becomes due to the government, or at least the tax portion becomes due.
Makes sense. So help me talk through the other side of this coin. Let's say that I've been paying quarterly taxes every year for the past, X number of years, because that's just how it's set up. That's how I've been doing it. Is it possible to switch to doing this system where the payment is at the end and not do the quarterly taxes?
As long as we're speaking about someone who has, a closely held business where they control their payroll, yes. Because there is no requirement to be on estimated payments simply because you might have been for the last 20 years. Each year does stand on its own, and the IRS does not know whether you're responsible for estimated payments or not until they get your return, which is after everything is all over. They may have an idea because most people, typically years are similar, so they might even send a reminder, hey, you didn't send in an April payment or a June payment, but that's not an absolute due date because your return will dictate. So what happens when one files their return, let's say in April or even in October if you go on a valid extension, then the IRS goes to the return and says, okay, we now, Dr. Freeman filed a return. His tax bill was $100,000. Now let's go back and look and see when he paid. But they don't know what your tax bill is till they get your tax return. Everything's all over. So you have more of the responsibility to estimate than the IRS does, because you have some control, maybe not total, but some control as to what's going on, or at least access to information that the IRS doesn't have. And then your tax return basically gives them all the information that they need, and now can look and see, like in this April, people will be filing their 25 tax return. IRS doesn't know anything about anybody's 25 return yet. They haven't got anybody's return yet. They know nothing.
Okay, well, let's talk about 25 for a minute. So if you'd been paying quarterly taxes, you paid your first quarterly, you made a quarterly tax payment in April of 25, and then throughout the year, correct?
Okay, if you were making it, that is correct.
If you were doing that. Now, so you and I were recording this in January of 26. And so when is a quarterly payment due?
The actual fourth quarter, they give you an extra 15 days, so it's actually January 15th is the fourth quarter.
Okay, so for last year, so if somebody's been doing quarterly taxes, by January the 15th, they pay their quarterly in January of 26 for 25.
That is correct. That would be their fourth estimated payment for 25.
And then the first quarterly payment for 26 wouldn't be quote unquote due until April?
That is correct. April 15th is the first estimated tax payment. The April 15th is a double witching, because if you should owe anything for the old year, let's say this April, if you file your return and you owe, $1,000, you obviously have to pay that.
Right.
As well as now setting up your first quarter of estimated payments for 26. And then you're on your way and running into 26.
Right. So if you decide, if a person decides that they're going to do this through the payroll and make the one large payment at the end of the year, as long as they've made that decision and gotten the quote unquote bugs worked out of it, but by April, then they're off and running.
Yes. In other words, you can, obviously the advantage of doing it right away in January is that you have 12 months to set aside that money. So from the investment return that we were speaking about, obviously investment return is a result of time and money.
Right.
So if you haven't set aside anything in January, February, March, well, you've taken away 25% of the benefit that we kind of spoke about.
Right, but if you put that January money aside in January, it's going to sit there and grow
longer.
All through the year until that middle of December time.
Correct. So effectively a year, just about.
Right, almost a year. So and I can't stress enough, that if you're going to do this strategy, you want to make sure that money is indeed put aside in a safe place where you have a virtual guaranteed return to make this all work.
Yeah, I mean, that would, like any other investment dollar, your investment tolerance, one could gamble and put it into a high leveraged security investment. And if it works out, great. And if it doesn't work out, well, now you still have to pay your tax and you don't have your money.
Yeah, that's a bigger problem.
But yes, and I'm not, to be honest, I'm not an investment counselor. So when I tell a client and advise a client, okay, I think you could probably put this away, and like you said, safely in a state mutual, municipal bond fund or whatever, of course, relatively safe, very, very safe. Some clients might say, well, I want to be a little more aggressive with that. Some years, and if I'm doing this year after year, some years I'll make a few dollars more than that, and some years I may not quite make that much. But that's an investment analysis. But being just outright secure, doing the municipal bond, pretty much as predictable as to what you'll have, and you could almost calculate on a piece of paper and pencil, at least back in the old days if people have paper and pencil, and calculate, okay, my $100,000 tax bill, I'll end up with $102,000 or $103,000, and that's because I've done this set aside and paying as late as possible. Like anything else in running your business too. Even on a small scale, if you have a bill that's due in 30 days, well, why do you pay it today? You don't. You pay it in 30 days or pretty close to it for the same reason. Now, when it's smaller items, it might not make sense to jump through so many hoops. But let's say it's a large bill. Let's say you buy a piece of equipment for your office. $100,000 piece of equipment. If the vendor is giving you 90 days to pay, well, you pay that in 90 days then.
Pay it on the 89th day, right?
Yeah, if it's a $5 bill, then you probably don't worry about it. But the tax is a significant number for people, as well as, let's say, a significant purchase that one might make in their practice.
Right. Well, then you start getting into, and this is totally off topic, there's a section of the tax code about buying new equipment and the tax benefits that are related to that. And I can't think of what section it is.
Section 179.
179.
Bonus depreciation, right? And now, I'm sorry, that's the first year depreciation. Now there's bonus depreciation as well. So the fact, and that's fine. And those are great tax deductions, of course, and that's perfect. But the payment that we're speaking about is above and beyond that tax savings. Mm-hmm. Okay. It's still just the cash flow of holding the money longer in your name instead of the tag of the IRS or the vendor or the bank or whoever we're speaking about.
So what I'm really hearing you say is working closely with a smart CPA to manage cash flow and accounts payable and accounts receivable ends up being a huge win for the business, for the practice.
Yeah, well, it's managing your cash, especially in a chiropractic business. It's not a hugely capital-intensive business, although you do have investments in certain things. It's not like you're buying and selling inventory and buying multi-million dollars of pieces of equipment. And generally, when you buy your equipment, I'm assuming you buy it and have it for a lengthy period of time. It doesn't have to be retooled and rechanged or changed frequently.
No, true.
I'm sorry?
No, yes, that's true. The equipment lasts a long time.
So it's the cash is very close to what the profit is. And some other businesses, that's not always the case because you have so much in payables and so much in receivables and everything else and tied up in this and that, you might have a lot of cash and not much profit, or the other way around, you have a lot of profit because everything's tied up in your receivables and you don't have cash. Most chiropractors don't have a tremendous receivable issue. They usually get it fairly steady, and especially through insurance companies and self-pay, up front or shortly thereafter. So the cash that is there closely resembles the accounting profit.
Makes sense. There are certain practices where the cash flow can lag significantly. Because of legal proceedings that are holding up the payments.
Right. That's true. Right, and that's a different because they get paid when cases settle, and then you have our friends, the attorneys, who take 3 or 4 years to solve a 5-minute problem.
I won't comment on that. All right, so let me ask you a question, because you've been kind enough to share all of this knowledge and wisdom in your time, even during as we're in tax season right now. If somebody had questions, do you work with clients in other states or only in the state that you are in?
Yeah, no, we have. I am in the Northeast. I'm in my offices in New Jersey. I'm licensed in New York, New Jersey, and Florida. But yeah, I have clients in many other states. Bulk of my clients are in my area. But yeah, the way that develops over a period of time, and I'm actually started my 40th tax season. So over that time period, people have moved, and then they know people and word of mouth, and so you have handfuls of clients in various areas. And the other thing I do anyway, I'm upfront and honest. If something I can't handle, I do what I can to try to point them in a direction to find someone who can.
That doesn't surprise me at all. So if someone had a specific question for you, would you be willing to field that question?
Well, I certainly would field the question, and then if it was not within my sphere of expertise, I would do what I can to find someone, a larger firm. I'm not a large firm, but yes, I know people in large firms that's they basically can handle anything and everything. Obviously, their rates and billing is drastically different than mine.
Sure.
But at the end of the day, they can get anything done.
Sure. So our time is almost at an end. If someone wanted to reach out to you, Bob, and say, hey, I've got a question, or maybe I want to use your services, how would they best get in touch with you? Is it a phone call? Is it a website?
Anyway, my website is Zigman C.P.A.com. That's Zigman CPA.com. Phone number, email. We have clients that communicate with us, and I have some older clients that, they don't touch the computers, and I still have to mail things or meet them or whatever. and that's fine. So everything is, those are all different ways the client chooses to communicate. As long as we can communicate, then we can work things out. So it's just a form of communication that's changed.
I totally get it. It's like being in chiropractic practice. You have to work with the person the way they need to be worked with.
Right.
So, Bob, I can't thank you enough for taking the time, explaining this, and really sharing your knowledge and wisdom. Thank you so much, Mr. Robert Zigman, for taking the time and spending it with me today.
I appreciate it. Thank you very much. I enjoyed being on the podcast.
All right. And that's our show for today. If you have a question about today's show or your own practice, feel free to reach out at fortheloveofchiropractic.com. Before making changes to your practice, be sure to seek legal advice regarding those changes and regulations in your state. For the Love of Chiropractic is an RGF production, all rights reserved. And thanks for listening. Original music provided by Hunter Rich Music.